Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on August 27th, 2016. So we're through Janet Yellen and the Jackson Hole speech. Market, though, yesterday throws off some pretty significant signs of volatility. So what we're going to do here on this weekend update, first and foremost, I'm going to take you through some of the action that we saw on Friday, which I think is pivotal to be able to move forward into next week. Just understanding some of the trade action that we saw again in yesterday, which is Friday, during the trading session, again displaying some fairly significant signs of even extreme volatility at one point during the trading day. Really will set us up for what we can expect a bit next week. So I start here on this weekend update looking at the S&P futures. And here is trade yesterday. Obviously, as I say, a bit of a volatile day. S&P futures eventually closing only down 6 handles, which of course is 6 points down to the 2167 handle. But what is slightly disconcerting is over the last few weeks, I've been mentioning we've been trading in really this identical range, kind of day in and day out. You know, we've actually looked, for example, on a 30-day, we've looked at like a 1-hour chart, okay, 30 days back, and you will see quite literally there have been really 2 definitive ranges. One of them in and around what? 2160. The other primary range right here at 2180, and this is to the S&P futures. So what we've actually gotten is this tremendous contract size that's accumulating here. You know, between options, futures, and all the stock that's trading, think about, again, what I called the $100 billion pile of risk. Think about how many contracts have been traded accumulating. Sure, some option contracts are put on, some are taken off. Then, again, right in here at the 2180. So for the most part, I've kind of theorized the moment we really start to move, it's going to be violent. All right, an extreme move expected. What we did yesterday was, well, quite entertaining to say the least. We actually tested the upward bounds of this range as well as right here into the 2160 range. And lo and behold, you can see volume. It's kind of hard to read volume on the kind of hourly chart, but you can clearly see that volume, all right, yesterday's trading session is, you know, above and beyond any of the recent trading sessions. But just how much so? Well, again, let's go back to just a 1 minute of yesterday and display what I said is kind of violent, if you will, volatility. And the only way to describe that to you is to look at one specific move here, and I'm just going to zoom in on it. This is a move that started, again, during, you know, Janet Yellen came on. Markets actually rallied, waited a while, and all of a sudden we had what turned out to be a pretty phenomenal sell-off, only to see, you know, dip buyers come in later. Nevertheless, as I said, a lot can get revealed inside of a large move. So here we are trading at 2184. And again, this is critically important moving forward. 2184, which is outside the range to the upside, within a period, again, and here we are at like 8:30, 8:32 in the morning. Okay, here we are, pretty much the bottom, 9:10 in the morning, within a period of about 40 minutes. We actually traded 2184 right into the 2160 range. Roughly speaking, we traded about 23, 24 handles in the S&P futures. So let's just call it 24 points, and the S&P futures gets taken off inside of 40 minutes. Okay, and then of course we sit in and around, we don't bottom out over here. Okay, we sit in around 2160. Why does that not surprise us at all? Because there's a huge amount of risk piled at 2160. So the hedging, which is all done by algorithms today, all the hedging activity starts to spiral again right in and around this range. Okay, everybody's got contract size on, everybody's comfortable right in this range. They hedge them, we're all good. Okay, we ended up rallying back up, not surprising. This vast of a move, though, a 24-point move, you know what the probability of that happening is? Not large at all. Why do I say that? Well, let's look back for a moment to the SPX. And again, there are some signs of volatility emerging here, but the volatility itself, okay, in the SPX is not necessarily displaying that. So let me bring you forward again to next week, and I'll bring you back again to what I saw on Friday that I think is a bit alarming. If you look at the 6-day options, okay, that takes us through Friday. All right, coming into a holiday weekend, so everybody remember, it's the end of summer. All right, forget about the end of summer. It's the beginning of football. But if you take a look throughout this coming week, the 6-day expected move, is sitting what? Right at around, we'll call it $28, $29. You do realize that in a 40-minute period, we saw a 24-point S&P move. And yet all of next week is only displaying $29 of risk. Yeah, don't sign me up for that one. All right, you are sitting on a ridiculous pile of risk. Okay, what ultimately is going on right now is the hedging activity is dampening down. It's like throwing a wet blanket on a party over here. It's dampening down the volatility. We think that we're locked in this range. Okay, make no two ways about it. There's a lot more risk, I think, than the market is giving us credit for. A 12% volatility. Yet on Friday, we display a 24-point move inside of a 40-minute window. You know, that kind of move is huge. Again, statistically speaking, we moved over 2 standard deviations, about 2.5 standard deviations to be specific. Now, I'll kind of cut to the chase over here. If you looked back over to yesterday, and this is what we're looking at here is end-of-day data. So bear with me here for just one moment. All right, this is the end of day 826. We want to look end of day of 825. The entire trading day, coming into Friday with, the Yellen speech was looking at about a 15-point kind of swing. Now, we moved inside of that. In the end, the S&Ps didn't move, okay, a substantial amount. They moved a couple of bucks over here. Sure, we had rallied back up to the close. But I want you to see how far the expected move, okay, was kind of smoked on an intraday basis. And what it entails, once again, is if you're a seller of option premium, you're going to get yourself in trouble in a hurry in this low volatility kind of climate here when, again, you get a 24-point move in a very short period of time. So last but not least on this front of seeing volatility emerging, well, this is another one that I don't think a lot of people are picking up on. So again, here's this radical move, okay? One thing I do want to point out is in the depths of volatility, like how do I really measure volatility? If the volatility itself, like the VIX or the vol futures, are not displaying it, how do I really measure it? Contract size that's flying through the market. These are 1-minute charts, okay? Literally 1 day, 1 minute. And I want you to see the S&P futures in multiple minutes. Now, having a heavy close, that's not unusual. We had multiple minutes, though, north of 20,000 contracts a minute. 20,000 contracts a minute. Put your helmet on, get under your desk kind of talk. And again, on a broader chart, I think you better look at this because, again, forget about so much what you think about direction right now. What you think about direction is inconsequential. Okay? Recognize the volume that we just did. Now, this is a 9-month chart. I'm going to zoom out for just a moment. Recognize the volume we did. We cracked right into 2.5 million S&P contracts. Now, for those of you, if you don't trade S&P contracts, that is fine. That is dandy. That does not matter. What does matter is the S&P futures. They're going to drive order flow to the rest of the marketplace. I don't care whether you trade a Google or an Apple, a Facebook, whatever you trade. You better realize the market just threw off the heaviest volume that it's seen since Brexit. I promised I would never say that word again. The British exit. Okay, this is the heaviest volume we've seen since the depth of the British exit, and that is something we better be looking at very, very carefully coming into next week. So if you don't normally look at markets on an intraday basis, that's fine. Just recognize Friday, Yellen speaks well after she spoke. Markets threw off some serious signs of volatility. What we get moving forward over here, well, are we going to get any follow-through to that volatility? And that's what we're going to be looking for earlier in the week. Where do we look for signs of that? One of the places I would start to look outside of just the S&P futures, I think you should start watching the financials. The financials fared incredibly well this week in the face of adversity. And the reason the financials are doing so well is that the bonds sold off. Bonds sold off, interest rates go up. The financials yesterday ended up. But take a look specifically at the XLF, still hugging on to 24 like it is grim death out there. In fact, if you look at a number of interest rate sensitive products, okay, what are they? Bank of America, okay, JP Morgan, Citi, Morgan Stanley. Start looking at individual stocks over here. Bank of America had a kind of a breakout day yesterday. How interesting that Bank of America looks like it's actually breaking to the upside in the midst of the rest of the marketplace throwing off signs of volatility. Watch financials. This entire next week, you got to watch these financial stocks over here. I may be looking to position myself, okay, in the next few days into a short trade inside of Bank of America. This is what we would term a statistically significant move. Now, forget about earnings, which happened back here. When I say statistically significant, just the last few weeks of trade, this underlying has rallied in an inordinate amount. Let's just say it moved up, roughly speaking, $1. Now, $1, on what was a $14.50 stock, percentage-wise, is a lot. And typically, a dollar move, if you do look out here, a dollar move normally takes about a month of time. Okay, it only took us what? From low to high over here, that dollar was reached in roughly 2 weeks, just over 2 weeks of trade. Typically takes about a month of trade to move that far. So we are statistically stretched inside of Bank of America, which is actually going to leave open an opportunity for the stock to possibly come back in. But again, that's an underlying that I'm going to be keying into very, very carefully this next week. Another one that really stood out to me yesterday was Amazon, as many of the NASDAQ stocks lately have ever so quietly been fading, specifically Google. And for those of you that have followed Google, I had a bearish position on Google. That bearish position is now closed on Google, fully profitable. Okay, up 55%. We closed out Google. We're going to be watching Google throughout the course of the week. There's been slippage, a little bit of slippage inside of Apple. Facebook faring relatively well, okay, in recent trade. But here's another one, hugging on to 125 again, like it's grim death over there. So Amazon, though, possibly seeing a bit of a breakout. We'll look for Amazon at all-time highs into next week. Now, what else do we have coming up next week? Well, I'd be remiss not to mention the fact that there's a ton of different data points, a deluge of data, if you will, with the end of the week. Can you believe it's going to be September already? End of the week, Friday. The employment situation. Dun, dun, dun. Recognize this is the last employment situation that the FOMC is going to see before their next meeting. Their next meeting, of course, is going to be in September. Also recognize, statistically speaking. And again, I'm the quant geek here. I'm not the technical analyst on the crew here at TheoTrade, but I'm the quant geek. And the quant geek always knows September, statistically speaking, is the most volatile month in the marketplace. So, hey, coming into it, markets this past Friday threw off some signs of volatility. I'll tell you what. If there is volatility out there, the SPX isn't telling us about it. I mean, the SPX is trading blind. Look at this. Pretty much through the month of September. Like, you can go out 19 days, September, 12 volatility. Nothing. Less than nothing. All right, go a little further out in time. This even encompasses, like, the FOMC meeting, which now, the chance of, like, a rate hike, who cares? Okay, do you really think they're going to raise interest rates when Japan, the rest of Europe has gone negative interest rates? All right, it's becoming, again, laughable at this point. So they're actually thinking about, hey, you know what? Let's not even raise interest rates. Let's start in the U.S. doing corporate bond buys. Heck, we can go out and possibly buy ETFs. I'm talking about the Fed could go out and buy ETFs, just like they're doing over in Japan. So is that a possibility of why we're seeing low volatility? Absolutely. But again, we'll really want to key into this next week, which everybody thinks, all right, you're coming into a holiday weekend, Friday could be boring. It's not going to be boring. There's going to be action this week. Everybody felt the extreme move inside of the S&P futures, extreme volume in the S&P futures. We just want to see if there's going to be follow through. Remember what I'm saying, levels in the S&Ps. You start to crack under 2160, okay, or above 2180, it's going to get real quick. And we're talking, that's a very shallow move, a 7-point move to the downside, and you could really light a fire, okay, in the S&Ps. The same thing is true above 2180. We're seeing extreme trade and extreme volume and activity above 2180. With that, I want to thank everybody for joining us here for the weekend update. I'll be back on TheoTrade all next week. Have a great weekend, everybody. Bye-bye.